Mutiny aboard the USS Ivory Tower. Hello and welcome to today's Daily Blitz. In this video, we'll be looking into whether the pension crisis has finally reached liftoff stage. Boaz, you've been looking into some recent news about UK academics striking over their pensions.
Yes, that's quite right. So the University and Colleges Union has organised an 8-day strike. We're currently pretty much in the middle of it.
Has anyone noticed, or?
Well, I have, though it should be said that academia does have an issue with ivory towerism, and some of that is certainly on display with this strike. However, I think there is some important sort of gems to be harvested from this event, really, which is that the pension crisis as a whole is really starting to come to the fore. There've been quite a lot of stories in recent years, but it's really starting to increase in intensity. Now, in this chart that you can see on the screen now, this is from Google Trends, and this is the popularity for the word pensions crisis in Google News items. And as you can see, since June 2018, that number, the popularity for that term, has not reached zero. And as we're seeing with this, the college union strike, this is really just one symptom of the problem. And the problem, of course, comes back to, as with many things, interest rates.
Yeah, and the strange thing about this pension strike is that they're protesting despite actually having good pension returns.
Yes, that's quite right. So on I think it's a 3-year, a 5-year, a 7-year and a 10-year basis, the USS, the University Superannuation Scheme, the fund underneath it, the fund with the underlying assets, has outperformed its benchmark on all of those bases. So in one of the most benign market environments that has done very well for the assets of the fund still requires further contributions. And those can either, of course, come from the employer or from the employees. And what's happening is the academics are being asked to increase their pension contributions. And of course, they are rejecting that and opting to strike. Though, of course, defined benefit pensions in general are incredibly rare to find now in the private sector.
You see all of this as like the thin end of a wedge for a much larger crisis to come.
Yes, that's quite correct. So what's really driving this issue is the underlying interest rates. So defined benefit pension schemes, they pay a defined benefit, as the name would suggest, and the assets that can really pay for that are long-term government bonds, really, just low-risk debt that will pay an interest over time, allows these funds to then go and pay retirees in perpetuity, effectively, and even then, once they die, to their widows. Now, as government debt pays less and less and less over time, these pension funds have had a really big issue. So there's a chart on the screen here which displays interest rates and the liabilities of those pensions. And as you can see, as the interest rate goes down, the liability of those pensions increases the year after, and vice versa. Every time interest rates go up, the pension liabilities go down the year after. And so as interest rates are generally trending down, the issues for these pension funds are becoming more and more and more acute and much more visible, which leads us to this current strike at the moment from the university staff. So while it may be ivory-towered academics who are complaining about this, really this is going to be something that we're going to see a lot more of as time goes on.
What strikes me as strange about all this is that the more honest the pension fund is in terms of admitting it has a shortfall, the more likely it becomes a problem in the news with protests and opposition to having to contribute more or receive less. And that's really bizarre because usually if a fund is being honest, it's a good thing.
Right, how well could you expand on that? When you say being honest, what exactly do you mean?
Yeah, so when the funds measure whether they have a shortfall or not, it's not based on the current amount of assets and what's currently happening. It's based on a projection for the future. Now, if that projection for the future looks really bad, that's an honest appraisal, and it means we need to fix the problem now so that we don't have a real problem in the future. And that's what's currently in the news. It's not like pension funds running out of money completely. It's that their projections are predicting a problem in the future. And the question is, do we fix it now or do we wait until there is a shortfall?
So it's all about the liabilities, the future liabilities of these pension funds. And even though we've had such a very benign market environment over the last 10 years, these are becoming more and more and more acute. And so if you imagine what it's going to look like for pension funds, if we do actually finally have a bear market and some or a lot of the assets that they have purchased fall significantly in value, you can imagine that all of the strikes and the protests that you see now are only going to get much, much, much bigger.
So there you have it, folks. The pension crisis has reached liftoff point. Thanks for watching today's Daily Blitz, and don't forget to tune in tomorrow.